Hey everybody, welcome to the morning market briefing. It's Tuesday, March 3rd, 2026. Hope you're doing well out there. As a reminder, check out the Jacobs Ladder Group online, jacobsladdergroup.org. Click that donate button in the top right hand of your screen, and remember that on April 1st we are doing an educational event with that organization, which I'm pretty fired up about. Got a good list of folks that have said, hey, I want to come to this. So we'd love to have you if you're in the local area. I think lunch is at 12:30. Is that right, Tom? Presentation at 1.
Correct, yeah. So, yeah, get to us if you want to join in. We've had a number of people jump in, so space is limited.
Awesome. Ben, how we doing? How we feeling?
Not great.
Ben is not great. Let's jump in. Sorry, somebody run. I am in tremendous amounts of pain and unable to get my computer open.
I want to start off with just an update on the war and kind of the market consequences. Yesterday, of course, we saw oil go up a lot, and the rest of the market really didn't do much other than bonds. Interest rates really went up a lot as well. And today that's continuing. And I think, Tom, the primary market transmission mechanism for the impact of the war is via oil and the knock-on effect. So oil up means Fed is going to be tight, means all of the issues with liquidity, which means bonds sell off, interest rates go up, and all of the issues with liquidity that we've been lamenting for really the last 6 to 9 months come back to the fore. And so we're seeing that really hit tech stocks and a rush to the exits on a lot of entities. I mean, the Korea had one of the biggest margin loans outstanding because the stock market there had been just absolutely crushing it. I think it was up like 30-40%. Well, yesterday they hit circuit breakers because foreign investors were just selling anything. Samsung down 15%, SK Hynix down 16%. The market overall in Korea was down 7 or 8%. Japan's down 3%, 4%. Currencies the world over selling off as people just rush into dollars because dollars buy what? Oil. And so dollars is still a reserve currency, especially when oil goes up. And even gold is down this morning with the strong dollar. So that is the transmission mechanism, in my view, is that it's a global liquidity crunch predicated on austerity and hawkishness from a number of central banks. And even this morning, we got higher inflation in the Eurozone.
Yeah, I think that, I mean, a number of things. I was looking at the EFA index before we came in here, which is Europe, Asia, Far East, which is basically large cap non-U.S. And for the haters and losers who are saying the U.S. is the bad place to be, it's only down 4% today. So pre-market. So don't worry about us. U.S. obviously down right around 2, but you're getting twice the hit on foreign stocks this morning. But foreign bonds are selling off as well. I would caution a little bit of, there's been a lot of panic. I mean, if you go on Twitter, you look on CNBC, they're like, man, bonds are getting absolutely routed. If you looked back 1 month, the only area of the bond market that has sold off is the 1-year treasury. And that's because rate expectations have changed a little bit, but not even that much. They've moved back a little bit in terms of the 2 cuts that are anticipated for this year. They're just towards the end of the year now, as opposed to maybe perhaps starting in June. And so I would caution getting just absolutely psyched up about what you're seeing on TV on this massive bond rout.
Yeah, for context, the 10-year, which we've talked about a lot. Maybe 10 days ago, we talked about how perhaps the baseline of a 4.2 is now a 4.1.
Correct. And that's
about
where
10
we
days
are
ago,
right
and
now.
we're at 4.1.
Yeah, we're at a 4.098. So, I mean, we saw a tremendous run into bonds. It was awesome. And, you know, when the 30-year was at a 4.95, we were like, man, this thing's really sold off. And when it was at a 4.60, you know, yesterday I said, hey, let's maybe move in on the 20-year because the 20-year is virtually unchanged day over day. The 30-year got popped, the 10-year got popped, but the 20-year is roughly in line. And so that was the safe spot to be. And that's just looking at relative value on a curve. That was the right choice to be nibbling at 20-year bonds yesterday because you're basically flat day over day, whereas everything else has gotten popped. And even that is really not that extreme because we basically moved back to fair value. I mean, we were a little overbought on the 10 and 30 years. So I wouldn't be panicked here. I mean, for context, a year ago, we were roughly at a 485 on the 10-year, which was a real bond rout. That's what real pain looks like in the bond markets, and we're not there. We're just not seeing it. And I would imagine when we close today that bonds will still be outperforming stocks year to date, and a very nice place to be relative to other assets. I mean, particularly treasuries have done very well this year. So, but there's just this panic. We're getting in the panic mode. It's not dissimilar to Liberation Day. It's not dissimilar to when the war broke out.
Price hike.
Yeah, Putin's price hike.
This is now Kamani's cash crunch.
Yeah, so I would say keep an eye on it. Things obviously could get worse. Things could get better. And hanging your hat on whatever narrative is on CNBC today, I think is
fool's errand.
Yeah, fool's errand. Just like we were overbought. I mean, people were really excited about bonds, and then the snow globe got shaken a little bit, and they got less excited, but still relatively excited compared to where we were last month.
It's the whole, was it the Revolutionary War, guns and butter, and now it's just dollars and oil. So what do people want right now? They're scared they won't have any energy, and they're scared they won't have any dollars to buy the energy. And at the end of the day, when you have these issues, that's what happens. And so you sell what you can, and some of those which are less liquid, like the Korean stock market or like the Blackstone private credit fund, are going to get popped.
I mean, it's a real shame that we took over Venezuela right before this happened. I mean, a lot of people are saying that might have been the first move on the chessboard against Iran.
Did Israel tell us to?
Yeah,
like, hey, you guys should do this.
On the war front, we did get some updates. I actually thought, I don't know if you guys listened to Rubio talk yesterday. I found his messaging on the rationale to be the most effective of any that I've heard thus far.
I agree. I think it was the most effective and the most eyebrow raising.
Yes,
for me.
So Rubio, kind of at a high level. I think, well, two things. I'll start with Trump. On Trump, I think people, frankly, are overreacting to the days to weeks narrative, which we talked about yesterday, on how initially it seemed like, hey, maybe it'd be a couple days, now 4 to 5 weeks, or are we now moving into the months territory? In hearing Trump's comments on, 4 to 5 weeks, we're ahead of schedule, we're willing to go the distance, and then he really camps out on, I'm not going to get bored. We can take this thing as long as they want to take it. I think people are, in my opinion, are overemphasizing we'll take this thing as long as they want to take it to mean a shift in the timeline, perhaps more so than he means it as just a raw flex. I think there's some bragging there. On the Rubio point, he essentially said that we had belief and intelligence that implied that the next time Iran was really attacked, presumably by Israel, I think he even alluded to Israel, I don't want to put words in his mouth, but that they had confidence and reason to believe that the U.S. would be a target. Now, once you've made that move, and he even kind of put up the straw man argument of like, we didn't want to be answering to Congress about how we knew that was going to happen and we didn't do anything. We wanted to be on the offensive. How credible that is or is not, I'm not totally sure. I do think, however, there's some credibility that is being lent to it, given the fact that Iran got knocked out at the bar and just stood up and started swinging and launching stuff at everybody nearby. I think there's potentially something there, but I feel like that has been the best justification for why this is going on.
I think it's the best justification. I think my concerns are, frankly, that Israel's told the U.S., hey, we're going to attack, and then Iran's going to retaliate against the U.S., so you better join us in this attack, which is like, if that's what happened, I'm like, come on, like, or Israel's goading us into this, and we have American lives. So that's where that's when I talk about eyebrow raising, like that's where. Yeah,
I to be clear, I don't 100% buy the narrative, even that there was valid intelligence from Israel or otherwise that was going to happen, but it's like, at least here's an explanation.
Yeah, we've heard that before.
Yeah,
we've heard about preemptive strikes.
Yep.
We've heard about valuable intelligence that they're weapons of mass destruction. Things that I don't love. Mike Pompeo seems to really like this, which is not great in my eyes. I will say, though, there's a lot of talk about the forever wars, and what's always forgotten in that is that the actual first Gulf War was actually a swift success that was in and out in about 6 months and was a huge success. And, George H.W. Bush gets really no credit on the world stage historically, but was actually a pretty decisive and effective president as it related to a lot of things, but particularly the first Gulf War. So it is possible. Unfortunately, Storm Norman Schwarzkopf passed away in 2012, and so we can't have him at the helm this time. And Scud missiles are probably obsolete, but I think that there is a template for this that has been effective once in the past. It's just barely on the edge of my lifetime, and people don't remember it at all.
I mean, I would argue it's arguable there was a template the second time when, we went into Iraq. Saddam was gone in a couple of weeks. I know it took a few months for us to actually capture him, but he was not the leader of Iraq anymore. I think it's what happens next is going to be critical.
Is that the only public hanging you've ever watched on TV?
Yeah.
I think that was the people forget that they hung Saddam Hussein on TV.
So, people talk about it. The internet's wild now. That was TV.
Gaddafi just got stabbed in public, and that was pretty gruesome. But that was also on TV. But it's pretty crazy that was a thing we all watched, or I certainly did.
I did. Yeah. What was wrong with our parents?
Yeah. I was probably 25.
They're just like, you should watch this.
Yeah. I didn't have a bedtime, and so therefore I could watch an execution if I wanted to.
Yeah. I'm a man.
It's pretty shocking, really, in retrospect.
Everything. I'm curious, you guys. I know that on Kalshi there was a prediction market for the Strait of Hormuz. When's it closed? How long does it stay closed? I continue to go back to where we were a couple weeks ago, where I feel like that particular aspect of this story is kind of a nothing burger, to use the Tom language.
I don't know how you define closed. I tell you what, I would not, if I was a captain of a very large crude carrier, I would not go through the Strait of Hormuz. And I think that's why you're seeing oil prices go up so much. I do think that is a clear near-term strategic priority for the U.S.
Yeah, they sunk 11 ships in the Strait of Oman. So
I think that they recognize that. I also think Trump and Besant and all of these guys know that if the election was held today, they would get smashed. So they need an off-ramp both economically and militarily. And they know that. The question is, sometimes you don't get that off-ramp.
Yep.
And I think that's the biggest question mark right now.
Let's switch more domestically. We talked about the ISM report yesterday, just kind of previewing it. We saw quite a ramp in prices, which, given the narrative of what we've been discussing for the last 13 minutes, is not a positive sign, given the new backdrop and the environment in which we're living. But what were the big takeaways, Ben?
Underlying manufacturing continued to be in expansion territory. That's good news. New orders was in expansion territory, a strong 55.8, better than expected. Employment actually improved, which was a nice surprise as well. But prices was the big story. And this was blamed on the steel and aluminum tariffs. And unfortunately, this comes right into the teeth of these oil price increases. So you had prices going up. So the narrative in the market is prices were going up into this oil price spike, which is not going to help for prices. So that's the inflation narrative. I think that I need to understand these aluminum prices a little bit more. Aluminum prices are going up. Steel prices have kind of topped out a little bit. And so I want to understand that a little bit. I also think that there's a decent demand pull from data centers on both of those in both of those areas. So I think there's a whole bunch of things that are coinciding that makes inflation look like maybe it's coming back. And then this morning's Eurozone inflation coming in at 1.9, estimate was 1.7, probably doesn't help either.
You alluded to the Blackstone private credit fund, some cash looking for an exit, $3.8 billion moving out. That's 7.9% of the shares being redeemed. Blackstone is increasing the ability to get access to that. Previously was gated at 5%. They said, hey, we'll let you get 7%, and we'll make up the difference by chipping in ourselves and even leaning on employees to dump some money in here to make sure you can get your money. But not a place that I'd want to be.
Well, this is kind of scary. I mean, it's kind of Ponzi-like if you think about it, because
no, you can get your money back. I just need to get money from my employees first.
Yes,
Yeah.
and not only that, but we're also going to buy 7% of the whole shares, and we'll just hold it on our balance sheet. It's like a bail-in. Because Blackstone's so big, they're able to do that, and so they're able to use their own money to buy shares in their own credit fund from investors who want out. But what happens at all the private credit funds who can't bail in their funds?
The standalone. I mean, there are standalone operators who have a private credit fund
and
that
no
is all
capital.
they have.
And what happens if you're co-invested? Blackstone buys their own shares, but then someone else owns another chunk of that deal, and they're forced to liquidate. You know, I mean, that's where it starts to get really dicey. Is where is it held, and in what funds, and are you just going to get dragged down by forced liquidations? I mean, it could get messy. But the thing is, it's not really a credit story yet.
It's a liquidity.
But it's a liquidity story, and that can be almost worse. I mean,
and in an unregulated space. Like if this happened in a bank.
Yeah, it's similar to the Silicon
FDIC's
Valley
coming
thing
in.
where there was not credit risk taken on. It was poor balance sheet management and a lack of liquidity. But quickly oversight was brought. This is not going to have that quick resolution.
Yeah, the Treasury, the FDIC, and the Fed can't come in and say, you know what, we'll buy the Blackstone credit fund. They're not going to do that.
yeah, I
Well,
mean, like,
I don't know.
I hope not.
yeah, and you wonder, because it's unregulated, it's like, I couldn't say, hey, I bought you a Marietta City water bond and you need liquidity and I can't get a bid, so I'm just going to buy it out of your account at a price that's not set at market. You know, you just can't do that. There are rules. You know, we have the MSRB, the Municipal Securities Regulatory Board.
Yeah.
But like you know, there are certain cans and
There's
cannot
rules.
do's with buying muni bonds, and that, you know, it's the same way with corporates. I mean, you've got all these different things where you can't do that. But this is the Wild West. I mean, it's not the golden age of private credit. And the golden age lasted a very short period of time and was a fairy tale.
I mean, I think what's the biggest interesting thing to me over the last 2 months and really to start this year is that this has not been a global liquidity wave that people thought was coming into the year. And I frankly, I thought, I mean, with Kevin Warsh coming into the Fed, interest rate cuts potentially on the table, I think we're seeing the opposite in terms of liquidity. People are pulling their money out, which from our perspective, it actually creates some interesting opportunities on the buy side. I'm thinking about closed-end funds that probably the gaps to NAV will widen. So that's something that we're going to keep an eye out on. And so it does create some opportunities, but in the short term, it can create some real liquidity and some mark-to-market issues for a number of entities.
Ben, we did get reports from Target, Best Buy. Target up about 2%. What's optimistic there?
It's not as bad. They did say the commentary was reasonably positive about February. They say we saw a healthy positive sales increase in February, serving as an important milestone to our path back to growth this year. They do have new management as well. Guidance on margins for both Target and Best Buy were a little bit better than expected. Neither of them really seeing much in the way of sales growth, but Best Buy has an 11% short interest. So their stock is really ripping today just because it's not bankrupt, but I don't really see a ton of fundamental momentum there. It's similar to Nike from last quarter where Nike just wasn't terrible and the stock ripped and then it sold off for the last few months. So that's kind of my view on those guys.
Did they talk about how they paid $110 million to break their lease so they don't have to be in Minneapolis anymore?
I did not see that.
It's a real shame.
$110 million.
Has there been anything that's happened in downtown Minneapolis over the last
What's
4 or 5
wild,
years
though,
that make
like
you not want to be there?
In reading the story, what's wild is they still have a massive presence in terms of square footage in downtown Minneapolis. But what's wild is the lease that they're breaking was a building in which they basically sent everyone home during COVID and said you can work from home. They renegotiated the lease, did not bring everybody back, as I understand it, and then now have decided, hey, we'll pay $110 million to get out of this.
I mean,
that's sound management right there. Please subscribe to the YouTube channel. If you're watching it, we're trying to make a good push there. Get the alerts, like the videos. If you're on the podcast, please share it with a friend. And as a reminder, check out the Jacobs Ladder Group. Go listen to that interview we did about a week and a half ago with Amy Odell, who runs that organization. Come join us April 1st. If you have questions on any of that, please shoot us an email, tmmb@narwhal.com. We'll talk to you guys soon.